Welcome to this Quill Group Investment Committee update. I'm Mark Beveridge. With the large falls on the share markets last week, we wanted to take the time to provide a quick update, and there's 11 topics here that we're going to run through. First is the actual move in the S&P 500 last week, down 12.7% from the all-time high back there. And according to the semantics of it, this is a correction when we're down more than 10%, while a bear market is declared when we're down 20% or more. So at this point in time, we're still in a bull market. Just moving back a little bit further to get some more perspective, the US market's down 8.5% since January, and back to the levels where we were in April 2019 and September of 2018. This table is courtesy of Troy Bombardier at Bull Markets Co. It shows the history of S&P 500 moves that are greater than 10% in a single week in column 2 there. And then in column 3, it shows the returns in the following week. So what this is telling us is that in this current week that we're in, starting the 2nd of March, we have about an 83% chance that this week will actually see the S&P 500 higher than what it was on February the 28th. The human responses to the virus outbreak are certainly very clear and well reported on in most of the news channels. In economic terms, the Chinese Purchasing Managers Index numbers were reported over the weekend, and that was really pointing out the economic impacts, with the services PMI falling to 28.9. Now, a number below 50 indicates that the majority of purchasing managers see conditions getting worse and getting less demand for their products. So a number at 28 is almost unprecedented, and actually back below GFC levels even. But as we stated in our last update, it's not so much the illness but the government and human reactions via travel bans, cancellations of large events that will impact on economic activity. And we've already seen Switzerland cancel gatherings of more than 1,000 people. France has done the same for gatherings of more than 5,000. News Corp, for example, has halted all non-essential travel for its global employees. So although that aspect of the COVID 2019 is what's getting all the airplay, and rightly so, there are other factors at work here. The markets actually went into this decade with elevated valuation levels. And furthermore, the financial markets support, where the Federal Reserve's been injecting large amounts of capital into the banking system, appeared to be tapering off in February, and they in fact announced on February the 13th that that rate of repurchases will fall to only 25 billion per day. Another factor at work that could be precipitating the speed of these declines is the herding tendency in index funds, both on the way in and the way out, where stocks are really sold based on a spreadsheet and with no real consideration of the underlying value. And another factor, it's quite complex, but I think it's underappreciated, is the hedging of dealers' gamma positions as they square their options writing positions. As markets fall, they tend to sell into that falling market to hedge their gamma positions. So I believe that some of those things have had as much impact on the markets as the direct headlines that we're seeing in the popular media. While my earlier slides were suggesting that a bounce is likely on technical factors, the forward returns for both stocks and bonds is much diminished by last decade's strong returns, which were driven by lower rates and now resulting in high equity valuations and low yields. This chart overlays the stock price to the earnings before interest, tax, depreciation and amortization over the S&P 500 annual returns, which are then advanced by 10 years. In other words, what it's telling us what to expect when we look back 10 years from now as to what the returns from the markets will be. Now, while this metric is not of much use in market timing from month to month, it has been extremely useful in deciding when to be cautious and when to pay a bit more for active management. And with a high correlation of 94%, what it's suggesting is that 10 years from now, we may look back at the S&P 500 and see a return of minus 3% per annum for the decade of the 20s. Is that impossible? No. Have a look at our next chart. Back at the end of 1999, the US had its highest ever market valuation when measured by that price to EBITDA metric. The subsequent decade, produced a return of minus 33% in total, or about minus 3.8% per annum for that decade. It was definitely a good decade to avoid indexing, and the MSCI World Index didn't do much better, being negative in Australian dollar terms over that period as well. One of the star active managers in that period was one that we had in a lot of client portfolios, the Platinum Asset Management Fund, and their flagship Platinum International Fund, which charges a hefty 1.54% per annum in management fees, did a total return of 139% during that same period. Now, I sincerely believe that the current focus on fees, to the exclusion of considering what market regime we're actually in, is very short-sighted. Unfortunately, the misbehaviour of the banks in fee gouging has put the focus almost exclusively on fees, which I believe will be detrimental if it makes advisors exclude high-quality active managers because of that focus. This is just a reminder of what we said back in January when we made some comments on valuations, that PEs now exclude historical averages and that poor performances often follow good performances. And I also want to provide a reminder that intra-year drawdowns of somewhere between 10 and 14% are actually quite common and just a part of being an equity investor in any given year. In fact, it's quite rare for us not to have a year when the market falls at least 10% at some point during the year. No pain, no gain, as our fitness colleagues like to say. And finally, just looking at the portfolios, we can tell you that in the Quill managed accounts, we have our equities component at the lower end of our bands. In our balanced fund, the minimum we can have in Aussie equities is 25%, and that's where we're currently sitting. In the international component, we're slightly above our minimums, but some of those managers are very conservatively positioned at the moment. The preliminary returns from the 1st of January through 28th of February is about 0.68%. That is preliminary. We're waiting on the updated numbers from the international funds, which no doubt when we get the figures for February the 28th, Friday, will come down a little bit from that. In the Elston Quill portfolios, the EQ series, in the diversified, we're at the midpoint of our allocation to Aussie equities. And recall that last year in 2019, the Elston portfolio, the equities component, beat the underlying index by about 6%. So we have a higher confidence level that the managed account process will provide some outperformance in that Aussie equities component. The preliminary 2-month numbers there are minus 2.52% for the period 1st of January through the 28th of February. Again, some international funds might change that figure a little bit. That's the end of our update. We want to thank you for watching this update and keeping yourself informed. As always, your Quill advisor is available to give you any additional research or give you a quick update on exactly where your portfolio is at right now. Thanks for watching.